Hi folks, thanks for joining me today. It's Alex Klingelhaver from Exential Wealth Advisors, OKC CFA, CFP on Twitter. I wanted to talk to you today about a question that I get asked all the time, and that's what's a debt fund versus what's an equity fund? And really when we talk about a debt fund versus an equity fund, I want to talk about what's debt and what's equity. Those are two different investment classes and they have two different functions in what's called the capital structure of a company. Without getting too much into the details, debt is loans that companies have to pay by a certain date or perhaps their revolving credit. Equity is ownership stakes in a company, stakes that may grow over time as the company grows and profits accumulate on the bottom line of that company's balance sheet. Funds of those products are typically what investment advisors like myself and other folks here at the firm use to help allocate clients' portfolios. Debt funds typically have a little bit of a lower volatility because all they're doing is promises for folks to pay back money. Equity funds have a little bit of a higher volatility, meaning they move around a little bit more because the businesses may go up, may go down in terms of their profitability over time. Now, which should you invest in and how do they work in a portfolio? Well, certainly a debt fund is going to be a bedrock of any assets that you might need to sell to generate cash. And the reason why we use debt funds in that capacity, we use bonds in that capacity, is because in the US law and in international law as well, companies have to pay their debts before rewarding their shareholders. So you always have to pay your debts or else you go bankrupt before you give money back to investors in equity. So we call that being higher up in the capital structure of a company because they have seniority in the capital structure because money has to flow to debt holders first, to borrowers, to lenders first. We put those safe haven assets, we call them the war chest assets, over in a debt fund. On the equity side, that's where you get some growth. And the reason why is because over time, those funds tend to go up more, but be less stable in volatile markets because companies do tend to grow, the economy grows over time, and those profits flow through to balance sheets and flow through to investors. So debt and equity funds both have an important role to play in your overall portfolio. Typically, you're looking to have your safe haven assets in bonds, in debt funds. You're having your growth assets growing through the economy, growing through companies in equity funds. If you want some additional information about sort of the subdivisions of debt funds, the short-term, long-term, intermediate-term, junk, etc., we have that content for you. If we want some additional information on growth versus value in the equity space, we've got some content there for you. Feel free to subscribe here to the channel. Thanks very much, and if you want some additional information, feel free to follow me on Twitter as well. It's OKC CFA CFP. Until next time, I'm out. Hey, thanks for watching our channel. If you want additional information and entertainment, go ahead and click the subscribe button. It's right here. You'll get our content before anyone else. If you have something you want to hear me talk about, we've got a comment section down below. Why don't you click there, write something, and maybe we'll feature it tomorrow. Thanks.